Best people, how are you? It's Francis. Great to be with you. And in this video, this is what we're going to talk about. We're going to talk about specific trades, trades that our community have put on that have been exploiting the yen weakness. Some of them are in one particular pair, some are in another, and some of them are in a third. We'll go over some of those. These are trades you could have had if you were with us in the community, and that you can still have because they have great further potential. However, the original early entries, some of which with very restricted risk and highly expansive rewards, which we call breaking into a trade where there are multiple structures of setups that allow you to get on a small time frame with a tiny bit of risk, but that should have knock-on contagion, dominoes falling, that will give you the larger targets of bigger patterns. We are talking about trading patterns within patterns. Smaller time frames into medium, into large, and you are going to see how you yourself can multiply yourself to wealth, not adding each profit of each winning trade, taking a step back on a loss, add, the slower road, the relative acceleration of still this is slow dough, because we are not fast money exponents. The slow dough sticks, the fast money goes. That's the way of the world, and it's usually when people brag to me about how much fast money they've made, it's over leveraging, and as a result, they are one bad trade away from giving it all back. We are talking about the principles of actually how you can add an accelerant inside the confines of real tight money management with a known managed loss that is reasonable and acceptable relative to the percentage of your overall pot size. And this also will be mining the theme of the yen weakness and the hype. I'm going to contrast this with the hype and the mega Twitter chatter that is going on in around AI, and more specifically the performance of NVIDIA, and why one is the chosen goal and why it is versus now getting involved in the hype train. So let's just have a look as we go to the full screen with a little bit of a Twitter chat. I really like the feed actually on Happy Hawaiian. Give him a follow, by the way. Always interesting, there's something going on. But this is what he said, and this was my reply to this, and I want to discuss this a little bit more detail. I couldn't resist the mania, he says. So let's just highlight this. Grab a Koki pen, nice fat TG pink. All right, I couldn't resist the mania. I bought some, and then he's talking about put spreads on NVIDIA expiring 2025. That's how much he paid. Will come back when it closes or expires worthless. So regardless, he will be updating people on whether he made any money or not. I want to just go into a little bit more detail. Now, why do we say it's a gambler zone? Because for those of you that haven't seen the chart, that's what NVIDIA is doing. They've just recently had an earnings outcome, by the way. So if we just drop the time frame a little bit, get out of the weekly, you can see that they've been on an upside trajectory consistently. Oh, by the way, our beloved friend, small sidebar here in actual fact, for our beloved friend. Who is our beloved friend? Cathie Wood. That's right. For me, she represents the female investment manager version of elongated muskiness. She, of course, invested in Tesla. We're talking about Cathie Wood. The ARK Innovation Fund. The name of the game is innovation. If anything should be central to what she's doing, apart from metaverse, AI should be part of it. And ARK, I'm afraid to say, this is the Cathie Wood gap relative to the new mega bull on an AI, which is pumping at the moment, for which NVIDIA has been one of the biggest beneficiaries. There are plenty others that are in the line of chip makers that are also doing well, etc. But this is the new FANG in essence. And unfortunately, ARK sold out of all their NVIDIA and has been on the wrong side. So this is fund managers that don't have price behavior and price action as part of their tools, and then are making fundamental decisions and getting out of the big potential players such as Tesla. She reduced her exposure to Tesla, she reduced her exposure to NVIDIA, and went deeper down into smaller, further out risk, and that's not turned out too well for her. Anyway, we're not enjoying somebody's pain, unnaturally so, but what we do want to highlight is that you need method for how you build your wealth. because you'll be getting out at the wrong times. So people are getting really excited about the fundamentals. You're talking about on a log scale chart. I've logged this chart. It was barely over $100, now close to 400, 389. Big gap on the earnings outcome. If I delog that, you will see that that is quite some move. 105 till just before the earnings, it was already knocking on the door of 300s. Now it's just a few dollars shy of the 400 mark, and has taken out its previous high that went with the proliferation of 2021. So people are wanting to get involved, they're wanting to discuss. And everyone is saying, we should sell puts, we should go. Now this could be a results-based blow-off gap, and you could have a trend change. But it's a massive gamble with only 2 candles to actually go in and buy puts on the basis that that gap must immediately close. This is what I call no man's land gambling. Where is your stop loss? When you are trading something that is going so strongly up, you have very little opportunity for tight risk, and you don't know how much more reward will come. There's no geometry, there's no pattern. So here's where we want to pivot you to a totally different market and a totally different scene. So our community was watching, and a number of our key members were getting into a real upside HVF. Now we are pivoting to the yen weakness scenario. And this is in an environment where rates have actually been showing signs of going up. And of course, the Japanese are doing yield curve control. So you're seeing the short end, the 1 month going up over 6% in America. You're seeing all the other debts that I've covered in the previous live streams recently. And in other markets, you're seeing the UK debts going up very close to the pension collapse levels of liquidity, which we referenced in a recent live stream and before. You've also seen the Italian debt that is set up for a squeezy it's going to look, let's just show it to you one more time. We've got to do it. Here we have the Italian debt, as we were describing, that was ready to go for a major break to the upside. By the way, we are predicting it's sitting at 4.3. We're predicting 5.84 plus with a possible run to 6%. This is going to probably point to maybe some euro malaise. We're going to continue to see the euro rollover. I highlighted how we called the euro is likely to roll over against our target of the head and shoulders. I don't want to recap everything that was on the live stream. Go watch that video. So what we're actually seeing is debt is getting high on the yield side and low in valuation, and the likes of the Japan that are attempting to hold their current levels of debt in and around the half, the 0.4s range, and doing yield curve control, meaning the currency has to take more of the hit, because if the debt's not devaluing, the currency must. And that's led to a great trade on the USD JPY, which I'll be passing by. But we were starting and illustrating the CAD JPY, and we wanted to show you those other debt markets. So as I was highlighting, you really want tight risk and expansive reward. And this particular structure that we saw was very symmetrical. It meets our criteria. So let's just overlay draw it for you. You can see this, there, and there. Very, very strong set of structure. And by the way, on a lower time frame, a wind up. You guessed it, at our second interim. You're talking about a method, guys, that tells you when you're likely to rest and get a little pullback. That's right. There you go. Hard sell-off. Gives you a new opportunity to get in case you missed it when we were getting in at the earlier point, and gives you a target point at which you can take profits off, whereafter you might gestate, pull back, consolidate, and generally not get much gain and burn time, which is cost of capital, opportunity cost, etc., etc. So closure of a short-term target, or at least partial position closure, unless you have a reason for an even bigger pattern to hold or to add back later to go all the way somewhere else higher. This is the opportunity that markets give if you understand them. So one of the key things we said in that exchange with the guys the NVIDIA side, it's best to actually resist temptations of being engaged in the major hype train of the moment, unless you were already involved when it wasn't hypey and you caught the low volatility into the highly expansive move. It's likely, as I state, that you are late on the long side, but almost certainly a little too early for the short side. So you're somewhere in the no man's land. Sometimes in those situations, the best trade is no trade. It's a gambler's reflex to want to be in something that everyone else is talking about. It's kind of like sitting outside the party and everybody's dancing to the tune and knows the songs and you're the only guy without it. You want to be with. Remember, true traders are comfortable with standing alone and not being engaged with the hype of the moment and the key hype train, especially when you have no sense for target, no sense for risk management, and it's just going up. Number going up. Best trades are usually undiscussed at the point that they are entered. And those entries should be on pending orders, typically not at market, at a key level being run that quietly happens that very few people are noticing. And then subsequently, as they start to make new highs, become the news. In short, you have to be before the news, not part of the news. That is the key element and sign of a really, really good potential position. That's when you're strapped up in the seat, in the rocket, before launch, not chasing in to get in and getting burnt on the afterburners trying to get in. So here's where the rubber meets the road generally for trades. People need to focus on trades, not that are melting up. It's too late. You should have been in before. Your stop's going to be too far down and you don't know how much further it could come. And often in high volatility environments, high smackdowns can occur as markets overshoot. The low volatility periods that have happened slowly and slowly become almost boring to the point that nobody's paying attention. Those are the entries. As we saw with the structure over here, this is a great entry for the CAD. If you look at the kind of risk rewards, this brings in principles. Instead of being part of the hype of AI and, oh, this is the story, and bragging to your friends how you made so much money and you're on the theme of the moment and AI is everything and sounding like the cool person who knows all the new stuff. That is for the bragging rooms of the bar stool in terms of my thesis. Actually, the big story for me is far more macro. You've got one nation protecting its debt valuation at the cost of its currency, while other nations across the globe are all seeing debt valuations going down with yields going up. So they are actually controlling, at least to some degree, their devaluation of currency. In short, we get the example of right here with Canada. And then after running your second interim, you actually get invited again to do another entry for the target. But hold on, is that all? Is that all? Had you taken this draw, what about all the other things? There's a blue line here. Hey, it's at 100. That sounds like an interesting number. Maybe we should have another look on a bigger time frame. In fact, all our time frames start on the bigger time frame. You've got to have a look at the macro, and that is where we focused, and this is where we are, and this is where we're taking you. So let's go daily. Let's maybe make it a couple of days, go for 4 days, and let's bring this whole picture into view. So what in actual fact we're showing you, it's possibly a bit big. We drop it down to 3, get a bit more detail in here. So what we're actually talking about is the big collapse where yen was dominant strong after being so weak against the dollar and everything else for the exact reasons outlined. We had a substantial pullback. Everyone got in on the trade. That was the NVDIA moment. When you start grinding here, where you're getting regular down legs and then up legs, and the grind, the big grind has come, that's the dangerous part to be coming into this trade for longs. Whilst you are making marginally higher highs, eventually you fail to make one, and then you run lows on a break of a basing ascending grind line. This was the beginning of the big grind. That is not the point to be entering. It's far more risky, and there's more volatility on the downside, on the pullbacks. And as emotional people, you will end up being buyers somewhere here and eating early red. And if you're oversized, you'll eat too much. Buyers on the up. I should be in that. Down. I should be in that. Down. I should be in that. Down. And that's the turn. Down, down, down. Surely it's going to turn. Down, down, down. Even longer, wrecking your accounts because of lack of money management, lack of real strategy, lack of real understanding of volatility's role in markets, guys. Volatility's role in markets. You've got the right trade when you've got in during the super low volatility squeeze in here with a stop there, and the first bit of price behavior you get is the most generous bit. It is single-mindedly up and away from your entry, like that. You are in the zone and relaxed now because you've got fast-moving profits that have expansively taken you away from your tight risk that you set during a low volatility period because you were patient and prepared to look at things that nobody was talking about whilst they were chasing the new shiny thing, the Tamagotchi of the trading world, NVDIA, AI, etc., etc. It's going to go up. It's also going to go down, and it'll go up again and go down, and it'll continue to go up, and you need to capture it in the low moments once everybody stopped trading it. That's when you get the low volatility trades. So in actual fact, we, by definition, have been following the yen's progress and its very strong pullback post the dollar turn. And what do we see? We saw this reversal. It's been drawn on our radar quite some time ago. Again, it's a busy chart. We do a lot of work. We are real chartists. And this is like a sketchbook. To many of you, it won't make too much sense. So in essence, I will show you this. But we are expecting a level in and around on the CAD of 107 to be run. 107, friends, and you were at the 100 level. So in an FX trade, this is actually a substantial move, even though it probably only represents 7%. It's a substantial move compared to equities, greater leverage, and it's a positive carry environment for brokers because you can lend yen for very cheap. Whilst Canada has a better lending rate, higher rates. So you have a potentially at least neutral but positive, potentially positive carry trade that will continue to even pay you for holding it, at least not cost you for holding it. And this is the structure that's called RI, and that right there is a reversal. So the key level, the obvious round number, is 100, but just above that is probably the neckline, the level that was just run, 150. We will teach you, and you will implement with us and draw and see why and how we draw these things the way we do, so that not only will you get what we are trading by being a member in our community. First link in the description below. Click it, get a diary, book a time, show up for the call that you attend, have a chat, no obligation. Even after you've paid, if it's wrong for you, 14 full days. Say, sorry, I made a mistake. No question asked, return of funds. We only want the willing. It's only if you want to be there, my friends. We don't have to have anybody's money. So with the left shoulder here, now we treat this. That's a key level of significance, but I want to increase the relevance of the neckline, which is actually slightly higher. Why is it higher, you might ask? Well, find out. Come and join and learn all about it. So that key level of 100 is just run. It's just run a bit. You've got a very slight left shoulder. You're getting a W-styled head, complexity in head, and then you're getting a right shoulder that is broken violently with a sudden expansion of volatility and pulls back. And then, of course, we stumble on it. It is wrestling between this 100 and 105 zone, and that gives you your gift entry on a lower time frame with super tight stop. In short, it's our opinion you're not seeing 104.5 again. Your stop remains there. No, you don't trail it. It remains there. Give your trade air to breathe. However, for those that missed it, you get another invitation to join it for the 103 break, where it might pause for a while and chop around, but overall, the macro trend, and this is now 3 separate patterns, a break-in entry, the original upside HVF brought to you by the founder, the originator of Hunt Volatility Funnel Theory, gets you into the trade, and you hold all the way through for 107s, 106.9s, odd, likely to see the 107s fall. And that is a huge trade that you can take. We have broker platforms that will give you 100 and even some beyond 100 if you're not in Europe or US, access to leverage. But you need to know how to trade that, otherwise you will blow yourself off. That's like putting a hand grenade in your hand. Pull that pin and forget to hold the lever down and you will lose your head. So please understand, leverage is something you've got to earn the right to, given a certain set of unique criteria that you should know how much you're losing. How much am I spending on that red zone? This is an 11.2 trade, by the way, to the full target. That trade represents 21.5. That is coming out of this community. And by the way, you are already 40% of the way there to doing it. Are you 40% of the way to doing a reward that is 21.5 times larger than you risk? When last did you land a 21.5 trade? Do you realize that if you put $500 on that, your return is 21.4 times that $500? Do you realize that once you've done this a while, you might even have 1,000 or a bit more on that trade, and it could be really fruitful? But it doesn't happen overnight, and you do go sideways for a while. But you get gifts when you put the macro trend at your back, where you have multiple patterns all moving in the opposite direction, and you take it right down to the lowest time frame to squeeze your risk. Are you understanding the key principle of Hunt Volatility Funnel Method? Chase a mega mooning and be part of the hype squad of sheep. That is like queuing up for a vaccine to be one of the first, or do what is the quiet, slightly unique and contrarian thing, and focus on the thing that is low volatility that no one's talking about. In time, as this moves forward, you're going to hear news feeds about the loss of value in the yen, and that's usually the time as we are getting out and the hype squad are showing up to buy the top, as Kathy will likely return and buy the top of NVDIA. Who knows, maybe she won't. I hope for her sake a bit of luck. Anyway, what else can we say about this? Well, we've also put people into, if you missed the CAD, you could have been in the Aussie JPY. The Aussie JPY was setting up similarly, a little bit slower, and you could have got in. Also in a situation, beautiful situation, where you could run and jump in and you could get involved, but a little behind the curve. We had bad data come out of Australia, bit of a pullback, tiny bit slower. And then my favorite, which is the king fiat for times like these, one of my favorites, as I would say, for this trade, along with the CAD, is in fact the USD JPY itself. As the dollar got independently very weak after being very strong, we showed you this structure in the live stream, and this is what you missed. So what are the fundamentals of the trade? The same reversal structure, the same 137.5. I gave you some of an idea of a view for this. This is you trade the break there. Now, if you drop lower time frames, you may in fact get opportunities to optimize that stop. And what are we looking for? 148.5 on the yen, after the yen topped out after moon spiking through the 150. So this is going to be another critical key level where the news will be mega hype. Look at this movement in your favor. We're on a daily chart. You've gone from 133 to 140. That's huge. That's huge for FX, guys. That is absolutely huge for FX. Oh, wait, look and see. You weren't watching on a lower time frame, but squeezy that Japanesey, you could have potentially had an entrance point coming in there for you. Okay, so here's some of the examples of how you could trade it. And incidentally, it reaffirms where the CAD JPY is, the CAD, the loonie will be CAD USD, because they're probably likely to both be running their targets at the same time. That 148 that we were showing you for the dollar will probably coincide with that 107 that I think we were showing you on the CAD. This is how you trade. And now for you, if you just rush in here, where is your stop? It's quite natural for us to get a pullback. You'll be shaken out whilst we are still tucked in long. And this is a key point. Your stops, probably your safest stops right now would be just below the neckline at 137 if you were to have a reasonable chance of starting. And had you got involved earlier and you were expecting this up move, you could have stops anywhere here and here. So we are long USD JPY. Members of our community are long CAD JPY, and members of our community are long Aussie JPY, including me. So you are missing out on opportunities because you are not investing. You are chasing hype, hope, and pumpermentals instead of understanding the slow dough is your friend. You can multiply your way to wealth utilizing HVF method, the Hunt Volatility Funnel method, by using smaller time frame patterns as illustrated on the CAD JPY to break into bigger time frame patterns, which will give you 21.4 times your risk if successful, already 40% there. And you can learn the principles as you implement and be steered away from hype, Pepe coin, NVDIA, meme investing. In fact, meme gambling. It's not investing and it's not even trading. It is meme gambling, where you have no idea how much higher it could go. You have no idea the size of the wall of money that'll go in, or when it will stop and rest and decide to see if it'll come back down a little bit before it starts again. You have no ideas of where your stop could be placed. You have no point at which you can take off. You just think, number go up. That, my friends, is not a trading strategy. Money management, knowing your exit point, knowing when you accept you're wrong and you're getting out, having it sized to a certain amount, and having true targets that you can get out and reduce, either 100% or in exceptional circumstances we explain where a small residual could be retained, assuming all your pattern time frames targets have been met, and multiplying by using patterns within patterns that allow you, even after you've missed the initial break, to break into trades with a method that will even warn you when you will congest for a while. Not to worry, don't even have to turn the platform on for that day. Nothing particularly good. Don't watch it, sit it out and wait for the new resumption of the macro trend that you got into through trading early doors continuation patterns after a major reversal in the yen gaining strength for a pullback on what is a fundamentally flawed position by the Bank of Japan. Exploit the structural weakness, all with technical analysis, multiple patterns, tight risk and expansive reward. This, my friends, is learning to trade. Everything else is gambling. And I can assure you, we do not chase into high volatility, fast moving markets. We enter on low volatility with low risk. And then we hope that the news will come that will respond to the subsequent macro moves that our analysis expects. Sometimes it doesn't work. We've written the check for the amount we're prepared to spend. It is known it is a very low percentage of the overall pot size, and we eat our red and we move on and we wait for the next opportunity. Okay, till next time. That is the key to successful trading. If you are not doing it, you are actively doing financial destruction. Even if you've won recently a few times, you will eventually be caught out. You can win 9 times in a row. If you're not money managing, if you're not applying these principles, you only need one loss to set you even further back than you were before those 9 consecutive winners. Please understand, this is not financial information, but it is here to protect you from yourself. There is a dopamine biological effect of being engaged in the markets that is personally destructive to you. And if you are fascinating and looking at your device and always wondering and always in it, you are over dopamine to the trade reflex. Time to chill back down, apply process, be methodical, be rational, have mathematics on your side, have macro trends on your side, have multiple patterns on your side, have known losses on your side with far larger potential gains. If that resonates, you need to click that link, that very first link in the description below, and say, I'm ready to get serious. And that requires investment. You will be in a higher quality of people as peers. You will be in a higher quality of mindset surrounding, and your environment by which you practice your trading matters. There will be no meme shooters. There will be no pump chasers. There will be considered rational thought. Which peer group do you choose? Do you choose the free one because it's on Discord and it costs you nothing in, and you think that's the best advantage, and you're all nattering about how far NVIDIA will pump, guessing? Or do you go systemic, risk-based, proper, high reward to low money managed losses trading? That is your decision. I am giving you the opportunity. It is far more expensive to not learn to do something properly than to perpetually take losses long run, where your mental enrichment only remembers the good things. Think about your childhood. Most of it is awesome. It's called mental enrichment. You were anxious about teachers, the bully, not having done your homework, getting pushed around on the bus, plenty. You forgot all that stuff. It's called mental enrichment. When you look back, don't suffer the mental enrichment memorizing all your endorphin mega pump trades that in the end you never kept a single % of the open profits. Time to get serious. Click the link below. We'll catch you next time with more on this. Watch what happens with that yen. I am telling you, there will be articles saying exactly the contrary. We typically trade against mainstream news, particularly by the likes of Bloomberg and everybody else. Watch and see. How does that trade turn out? What did I predict for you? On the yen against the dollar, I repeat the number 148.5. Is it tomorrow? Most certainly not. Is it next week? Most certainly unlikely. Could it be next month? Possibly. Could it be the month thereafter? Possibly. Do I care? Let it work its way and do what it needs to do in the time frame that I've given it. Oh yes, I forgot to mention, we have real time stops on most of our setups as well. In the meantime, that CAD JPY that I was telling you about will make interim level targets, and that will be good levels of performance, and we could elect to take certain off, and we will teach you the criteria on what basis we do that as part and parcel of learning and implementing with us, helping you be someone who can earn his own living through the markets from anywhere in the world, where you can then reduce your tax that you pay to virtually near zero. Be fluid, be of many places and of none. This is the world of the nomad capitalist, and you can decide to be part of it. But you need skills. Until next time, I'll catch you later. Bye.